On January 21st, 2026, gold futures crossed $4,756 per ounce. That's not a typo. We're not talking about some distant prediction or analyst daydream. This happened right now while you're watching this. And here's the part that should make your stomach drop. Silver just hit $95.40, smashing through levels we haven't seen in decades. But this isn't about shiny metal getting expensive. This is about what happens when the entire global financial system starts sweating. Because in exactly 11 days, on February 1st, the United States is about to slap massive tariffs on 8 European countries, unless Denmark sells us Greenland. Yeah, you heard that right. Greenland. And the markets are absolutely losing their minds. Gold isn't climbing because people want jewelry. It's climbing because smart money is running for the exits. So here's the question that's going to define the next 2 weeks. Is $4,700 the peak, or just the warm-up act before February 1st turns everything upside down? Stick around, because what happens next could rewrite how we think about money itself. Part 1. Background. Root cause. When safe havens start screaming. Let's get one thing straight right off the bat. Gold is boring until it isn't. For most of human history, gold has been the ultimate insurance policy. When everything else goes sideways, when governments start printing money like it's monopoly cash, when wars break out, when economies implode, people buy gold. It's been that way for thousands of years. Gold doesn't care about your politics. It doesn't care about your economic theory. It just sits there, being gold, holding value when paper promises fall apart. But here's what most people miss. Gold isn't really an investment in the normal sense. You don't buy gold because you think it's going to generate profits or pay dividends or create value. You buy gold because you think everything else is going to lose value. It's a vote of no confidence. It's financial pessimism in physical form. And right now, that vote is being cast harder and faster than almost any time in modern history. Think of gold like a fire alarm in a building. Most of the time, it just sits there on the ceiling, quiet, doing nothing. You forget it exists. But when it starts screaming, you don't stand around debating whether there's really a fire, you move. And right now, gold is screaming so loud that the entire investment world is starting to panic. The traditional narrative about gold is that it's an inflation hedge. When the government prints too much money, when your dollar buys less bread and milk, gold goes up because it takes more inflated dollars to buy the same ounce of metal. That's economics 101, and it's true. But what's happening right now is different. This isn't about inflation. This is about something way more fundamental: trust. Investors are fleeing traditional assets for safe haven commodities because something called the Greenland conflict is escalating. We'll get into what that actually means in a minute, but the short version is this. The biggest, most stable, most powerful economy in the world is picking a trade fight with some of its closest allies over a giant frozen island most people couldn't find on a map. And the markets are interpreting this as a sign that the entire geopolitical order, the thing that's kept global trade stable for 80 years, might be cracking. Now here's where it gets really interesting. Silver. Silver just hit $95.40. For context, silver usually trades like gold's annoying little brother. It goes up when gold goes up, but it's more volatile, more industrial, more tied to actual economic activity. Silver gets used in electronics, solar panels, batteries. It's half investment metal, half industrial commodity. So when silver not only rises with gold, but actually outperforms gold on a percentage basis, that's a massive red flag. When both metals are moving violently upward together, that's not about inflation expectations or industrial demand. That's about system-level fear. That's about investors looking at every major asset class, stocks, bonds, real estate, even crypto, and saying, no thanks, I'll take the shiny rocks instead. It's a primal financial panic response, and it's happening in real time. Here's the thing about market fear. It's anticipatory. Markets don't wait for bad things to actually happen. They price in the possibility of bad things happening. Right now, gold and silver aren't rising because of damage that's already been done. They're rising because of damage investors think is coming. The Greenland conflict, this bizarre geopolitical mess we're about to dive into, hasn't even fully played out yet. The tariffs don't even start until February 1st. But the market is already running the scenarios, calculating the odds, and deciding that holding actual physical metal is safer than holding promises printed on paper, by governments that might be about to go to economic war with each other. This is anticipatory risk pricing. It's the market saying, I don't know exactly how this ends, but I know I don't want to be holding the bag when it does. And when that sentiment takes hold across global markets, when trillions of dollars start repositioning based on worst-case scenarios, that's when safe havens don't just rise. They scream. Part 2. Escalation. The Golden Dome Gambit. Okay, so why is any of this happening? Why is the United States suddenly obsessed with buying Greenland? The answer is equal parts terrifying and absurd, and it involves something called the Golden Dome. The Golden Dome is a proposed $175 billion missile defense system. Let me say that number again. $175 billion. That's more than the entire GDP of most countries. This isn't some minor military upgrade. This is a next-generation defense shield designed to protect the United States mainland from hypersonic missiles, cruise missiles, and AI-enabled drone swarms. And according to the people pushing this project, it absolutely has to be built in Greenland. Here's why. Geography. Greenland sits right between North America and Russia. If Russia launches missiles at the continental United States, those missiles have to fly over or near Greenland. That gives Greenland a unique position in terms of interception timelines. In missile defense, seconds matter. The difference between detecting a launch over Greenland versus detecting it closer to US airspace could be the difference between a successful intercept and a city getting vaporized. It's brutal math, but that's the calculation. Greenland already hosts something called Pituffik Space Base, which used to be called Thule Air Base. This base has been there since the Cold War, and it's critical for space-based tracking sensors. The sensors at Pituffik can detect missile launches, track satellites, monitor space debris. Is one of the most strategically important pieces of real estate on the planet, and it's been quietly doing its job for decades. But now, the US wants to massively expand that infrastructure to house the Golden Dome, and that requires not just leasing the land, but owning it outright. Here's where it gets complicated. Greenland isn't an independent country. It's an autonomous territory of Denmark. Denmark is a NATO ally. Denmark is a stable, democratic, wealthy European nation that has absolutely zero interest in selling Greenland to anyone. For Denmark, Greenland is part of their national identity. It's part of their territorial sovereignty. And the idea that the United States would just roll up and demand to buy it, like it's a used car on Craigslist, is deeply offensive. But from the US perspective, this isn't about offense or diplomacy. This is about existential defense. The argument goes like this. Hypersonic missiles are real. AI-controlled drone swarms are real. The next generation of warfare is happening right now, and if the United States doesn't build this defense system in the optimal location, American cities are vulnerable, and the optimal location is Greenland. End of discussion. So you've got two completely incompatible positions. Denmark says, you can't buy sovereign territory like it's a real estate deal. The US says, we need this for national survival, and we're willing to do whatever it takes to make it happen. And that whatever it takes part is where things went off the rails. This is non-traditional geopolitical escalation. We're not talking about military invasion. We're not talking about sanctions over human rights abuses or nuclear programs. We're talking about the United States threatening economic punishment against close allies because they won't sell us an island for a missile defense system. It's bizarre, it's unprecedented, and it's exactly the kind of thing that makes global markets freak out. Here's why this matters for gold and silver. Defense infrastructure decisions are now driving commodity markets. Normally, commodity markets respond to supply and demand, to industrial output, to currency fluctuations. But when a proposed defense system becomes the catalyst for a trade war between the United States and Europe, commodities stop being about economics and start being about survival. Investors look at this situation and think, if the US is willing to blow up trade relationships with Europe over a military base, what else are they willing to do? How stable is anything right now? And the answer they're arriving at is not very stable at all. So they buy gold, they buy silver, they get out of anything that depends on international cooperation, stable trade relationships, or predictable government behavior. Because the Golden Dome Gambit just proved that none of those things can be taken for granted anymore. The perception of irreversible global fragmentation is setting in. For the last 80 years, since the end of World War II, the global order has been built on alliances, trade agreements, international institutions, diplomatic norms. That order is creaking. And when investors start to believe that fragmentation is irreversible, that we're entering a period where every nation is fending for itself, where alliances can be discarded over a single policy disagreement, that's when safe haven assets go parabolic. Gold doesn't need the world to end. Gold just needs people to think the world might end. And right now, the Golden Dome Gambit is giving them plenty of reasons to think exactly that. Part 3. Core conflict. The tariff that lit the fuse. So how exactly is the United States trying to force Denmark to sell Greenland? The answer is tariffs. Massive, escalating, deadline-driven tariffs. And this is where the February 1st date becomes absolutely critical. Here's the timeline. On February 1st, 2026, the United States is implementing a 10% tariff on goods from Denmark, Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland. That's 8 countries. These aren't random countries, these are some of America's closest allies, major trading partners, fellow NATO members, and they're all getting hit with tariffs because Denmark won't sell Greenland. But it gets worse. If no deal is reached, if Denmark continues to refuse, the tariff rate jumps to 25% on June 1st, 2026. This is a pre-committed threat. This is the United States saying, we're not negotiating, we're not hoping you come around, we're telling you exactly what will happen and you have a deadline to comply. This is a deadline-based coercion model, not a negotiation. In a normal negotiation, both sides have leverage, both sides make concessions, both sides walk away with something. This isn't that. This is economic hostage-taking. The US position is essentially, sell us Greenland or watch your economy suffer. There's no middle ground being offered. There's no compromise proposal. It's binary, yes or no. Comply or pay. And Europe is not taking this well. The European Union is considering an emergency package of tariffs on $108 billion of US imports, potentially starting February 6th. Think about what that means. If the US tariffs hit on February 1st and Europe retaliates on February 6th, we're looking at a full-scale trade war between the United States and Europe erupting in less than 2 weeks. These are the 2 largest economic blocs on the planet. Together they represent more than half of global GDP. If they start trying to economically destroy each other, there is no part of the global economy that doesn't get hit. Now, here's why markets hate this so much. Binary outcomes with fixed dates. Markets love gradual change. Markets love predictability. Markets love situations where there are multiple possible outcomes and room for adjustment. What markets absolutely despise is a situation where everything hinges on a single yes or no decision with a hard deadline, because that creates massive uncertainty, and uncertainty is poison for asset prices. Think about it from an investor's perspective. You're holding European stocks, you're holding US bonds, you've got investments in companies that depend on transatlantic trade, and you know that on February 1st one of 2 things happens. Either Denmark caves and sells Greenland, which would be a geopolitical earthquake in its own right, or the tariffs hit and a trade war starts. There's no scenario where things just stay the same. No scenario where this quietly goes away. It's change or catastrophe, and you have 11 days to figure out which one is coming. So what do? You de-risk. You sell assets that are exposed to this mess. You move into assets that will hold value regardless of what happens, and the ultimate regardless of what happens asset is gold. Gold doesn't care if Europe and America are trading partners or economic enemies. Gold doesn't care if tariffs are 10% or 25%. Gold just sits there, being valuable, no matter what insanity is happening in the geopolitical realm. This is why gold futures are repricing risk so aggressively right now. Every day that passes without a resolution, every statement from a European leader condemning the US position, every hint that Denmark isn't backing down, that's another data point telling investors that February 1st is going to be a disaster. And the market doesn't wait for the disaster. The market prices in the disaster ahead of time. The tariff uncertainty is directly driving gold futures because gold is the anti-uncertainty asset. When you don't know what's going to happen, when the range of possible outcomes includes everything from total capitulation to economic warfare, you buy the thing that will definitely still have value on the other side. February 1st is the real driver of near-term price discovery. Every analyst, every bank, every major investor is looking at that date and asking, where will gold be on February 2nd? Because that's the day we find out if this was all a bluff, or if the global economic order just fractured in a way that can't be easily repaired. And based on current price action, based on gold hitting $4,756 and silver hitting $95.40, the market is betting heavily on fracture. Part 4. Institutional response. The flat no that shook the market. So with all this chaos brewing, with markets in freefall and gold screaming upward, what did the US government do? They sent out Treasury Secretary Scott Bessent to calm everyone down, and he did the exact opposite. At the World Economic Forum in Davos, Bessent was asked directly, "Does Europe have financial weapons that could harm the US economy?" His response was blunt, almost dismissive. No. Just flat out no, no elaboration, no acknowledgement of complexity. Just a hard, confident rejection of the premise. Now, in theory, this was supposed to be reassuring. The Treasury Secretary is supposed to project strength, to show markets that the US knows what it's doing, that there's a plan, that everything is under control. But here's the thing about reassurance. It only works if people believe you. And when you're reassuring people in the middle of a market panic by basically saying, "Trust me, they can't hurt us," that can backfire spectacularly. Bessent also dismissed what he called rumours of a European debt strike. There's been speculation that Europe could respond to US tariffs by dumping their holdings of US bonds and equities. Europe holds an estimated $8 trillion in US assets. That's trillion with a T. If European investors and governments decided to liquidate even a fraction of that, it would send US bond yields skyrocketing and stock prices cratering. It would be financial carnage. But Bessent called this a false narrative that defies logic. His argument is essentially that Europe dumping US assets would hurt Europe just as much as it would hurt the US. If you own $8 trillion of US investments and you try to sell them all at once, you're going to crater the price. You're going to lose massive amounts of money. It would be financial self-destruction. So logically, Europe won't do it. And on paper, he's right. It would be incredibly destructive for Europe to dump US assets. But here's what markets heard in that response: political rigidity. They heard a Treasury Secretary so confident in his position that he's not even entertaining the possibility of retaliation. They heard someone who believes that the US holds all the cards and that Europe will ultimately back down because they have no choice. That kind of confidence can be stabilizing if you're right. But if you're wrong, if you've misjudged the situation, if Europe decides that principle matters more than profit, then that confidence becomes a catastrophic miscalculation, and markets don't like betting on overconfidence. Bessent also repeatedly told European leaders and investors to sit back and take a deep breath, rather than retaliate. Again, this was meant to be calming. This was meant to signal that the US isn't looking for a fight, that this can all be resolved peacefully if everyone just stays calm. But telling people to calm down in the middle of a crisis often has the opposite effect. It sounds condescending. It sounds like you're not taking their concerns seriously. And when you're asking a sovereign nation to sell you part of their territory, and they're saying no, telling them to take a deep breath isn't diplomacy, it's dismissiveness. Why does gold thrive when diplomacy appears non-adaptive? Because non-adaptive diplomacy leads to conflict. When both sides dig in, when neither side is willing to compromise, when the conversation stops being about finding common ground and starts being about who blinks first, that's when situations spiral. And gold is the ultimate spiral insurance. Markets interpreted Bessent's stance as a signal that the US is not going to back down, that the February 1st deadline is real, that the tariffs are really going to happen unless Denmark capitulates. And since Denmark has shown zero indication of capitulating, that means the tariffs are coming, which means the trade war is coming, which means gold is going higher. Here's the paradox. Bessent's job was to calm markets, but his calm, his confidence, his refusal to acknowledge the possibility of serious retaliation had the effect of making markets more nervous. Because if the US Treasury Secretary genuinely believes that Europe has no financial weapons, then he's either right and this all blows over, or he's catastrophically wrong, and we're about to find out just how much damage a cornered Europe can do. And markets don't like those odds. Part 5. Consequences. When markets bleed first. While all of this geopolitical chess is playing out, real consequences are already hitting. The markets aren't waiting for February 1st, they're reacting now, and the bleeding has already started. The Dow Jones Industrial Average tumbled over 800 points in reaction to the trade clash. That's not a normal correction. That's not profit-taking or sector rotation, that's panic. That's institutional investors looking at the February 1st deadline and deciding they don't want to be holding US equities when the tariffs hit. 800 points is a confirmation of systemic stress. It's the market saying, "Sir, this is real. This is happening. Get out." But the stock market crash is just the beginning. Tariffs don't exist in isolation. They cascade. They ripple through every part of the economy, and the people who get hurt first are always the people who have nothing to do with the original conflict. Here's how tariffs cascade. The US puts a 10% tariff on European goods. European companies that export to the US now have to either raise their prices by 10%, which makes them less competitive, or eat the cost, which destroys their profit margins. Either way, they're in trouble. Some of them will lay off workers, some of them will cut production, some of them will go out of business entirely. But it doesn't stop there. Those European companies buy supplies from other companies. They pay rent. They have service contracts. When they cut costs, everyone in their supply chain gets hurt. And then Europe retaliates with tariffs on US goods, and the exact same cascade happens in reverse. US exporters get hammered. They lay off workers. They cut orders from their suppliers. And suddenly you've got job losses in industries that have nothing to do with Greenland or missile defense or geopolitics. Then there's inflation. Tariffs are taxes on imports. When imports get more expensive, consumer prices go up. Americans will pay more for European cars, European wine, European machinery. Europeans will pay more for American tech, American agriculture, American services. And when prices go up across the board, people buy less, demand drops. Businesses suffer. The economy slows. Energy insecurity is another layer. Europe is heavily dependent on global energy markets. If a trade war disrupts supply chains, if it makes it harder to move oil and gas and coal and renewables across borders, energy prices spike. And when energy prices spike, everything gets more expensive. Transportation, manufacturing, heating, electricity. It all goes up. And then there are the employment shocks. Tariffs destroy jobs. Not immediately, not all at once, but steadily, predictably, brutally. Every study of major tariff regimes shows the same thing. Short-term political gains, long-term economic pain. Workers lose jobs. Communities lose industries. Regions lose economic vitality. And those effects last for years, even if the tariffs eventually get rolled back. This is the humanitarian cost of geopolitical brinksmanship. It's not abstract. It's not theoretical. It's real people losing real jobs, paying higher prices for basic goods, watching their savings get eroded by inflation, facing an uncertain economic future. And most of those people have no idea why any of this is happening. They don't know about the Golden Dome. They don't know about Patufic Space Base. They just know that suddenly everything costs more and their job is less secure. And here's the brutal truth. Gold is reacting before civilians feel the impact. The commodities markets are the canary in the coal mine. They're pricing in the pain before it arrives. Gold hit $4,756, while most people are still going about their normal lives, unaware that in 2 weeks their economic reality might fundamentally change. This is why gold is rising. It's not because gold investors are smarter or more informed. It's because gold is a shield against social instability. When societies become unstable, when governments make unpredictable decisions, when international cooperation breaks down, holding physical assets becomes more valuable than holding financial promises. And the rise in gold and silver is a direct reflection of investors bracing for exactly that kind of instability. Markets bleed first, people bleed second, and right now the markets are hemorrhaging. Part 6. Forward Outlook. How high before the bell rings? So where does this go from here? That's the $4,756 question. Literally. As of right now, gold futures are confirmed at $4,756 per ounce. Silver is at $95.40. These are not projections. These are current market prices. This is what gold and silver are trading at while you're watching this video. And the question everyone is asking is this the top, or is there more room to run before February 1st? Major banks are now forecasting gold to reach between $5,000 and $6,000 later in 2026. Let me be clear. That's speculation. Nobody knows for certain where gold is going. But when major financial institutions start putting out price targets that high, they're not doing it for fun. They're doing it because their models, their analysts, their understanding of market dynamics is telling them that the current trajectory points significantly higher. Why? because February 1st is acting as a volatility magnet. Every day that passes without a resolution increases the probability that the tariffs hit. And if the tariffs hit, if the trade war actually starts, all bets are off. The current price action is based on anticipation. Imagine what happens when anticipation becomes reality. Let's run through the scenarios. Scenario 1. No deal. Denmark refuses to sell Greenland. The tariffs hit on February 1st. Europe retaliates on February 6th. A full-scale trade war begins. In this scenario, we could see a panic bid into metals. Investors who have been sitting on the sidelines, hoping this would resolve peacefully, would rush into gold and silver all at once. That kind of buying pressure could push gold past $5,000 in a matter of days. Silver could break $100. This is speculation, but it's not wild speculation. It's a logical extension of current market behavior under a worst-case scenario. Scenario 2. Temporary delay. The US and Denmark agree to extend negotiations. The February 1st deadline gets pushed back. The tariffs don't hit immediately. In this scenario, we'd likely see consolidation. Gold might pull back slightly from current levels as some of the immediate panic dissipates, but it wouldn't crash. Because a delay doesn't solve anything, it just postpones the reckoning, and markets would continue to price in the possibility that the tariffs eventually hit. So you'd get a pause, not reversal. Scenario 3. Full capitulation. Denmark agrees to sell Greenland. This is the scenario Besant seems to think is inevitable. If this happens, gold would probably sell off hard in the short term. The immediate crisis would be over, the trade war would be averted, risk on assets would rally. But even in this scenario, the long-term implications for gold are complicated. Because if the US just successfully used economic coercion to force an ally to sell sovereign territory, what does that mean for the future of international relations? What does that mean for other countries looking at their alliances with the US? The Golden Dome might get built, but the trust that holds the global order together might be permanently damaged. The truth is, gold isn't just reacting to the immediate crisis. Gold is a barometer of trust. And right now, trust in the stability of the global system is at historic lows. Even if the Greenland situation resolves, even if the tariffs never hit, the fact that we got this close to a trade war between the US and Europe over a missile defense base is a signal that something fundamental has changed. February 1st is a psychological and financial inflection point. It's the moment when speculation becomes reality. It's the moment when markets find out if all this fear was justified or if it was an overreaction. And based on everything we've seen, based on the positions both sides have taken, based on the rhetoric and the deadlines and the lack of diplomatic flexibility, it's hard to see how this ends well. Gold at $4,756 isn't the end of the story. It might not even be the middle. It might just be the opening chapter of a much longer, much more volatile period, where safe haven assets become the only assets anyone wants to hold. The clock is ticking. 11 days until February 1st, and every tick of that clock is another bid under gold, another rush into silver, another sign that the markets have already made their decision about what's coming. The price isn't rising, the clock is ticking, and when the bell finally rings on February 1st, we're all going to find out just how high fear can push the ultimate safe haven.